Hi, I'm Jenny Brown. Welcome to this week's MFB News. I hope you've all had a really good week and are keeping incredibly well and have some wonderful plans lined up for this weekend. So what have we got for you today? So we're going to do our usual roundup of what the lenders have been up to. We're then going to talk a bit about what's going on with house prices, renters' behaviour, some licensing news, and also I'm going to give you some data in terms of kind of what's going on with buy-to-let lending more broadly in terms of the value of loans across the whole of the country, which will really kind of give you an understanding of what's going on with landlord behaviours in terms of increasing, decreasing their portfolio sizes. Okay, so first up, we saw the Bank of England increase interest rates again yesterday by 0.25% to 25 basis points, which now leaves Bank of England base rate sitting at 1%. Now, interestingly, 3 members voted for actually a 0.5% increase, not a 25 basis point increase. So actually quite a few of them wanted the increase to be higher than it actually turned out to be. So on the back of this, people are now predicting a further rate rise in June of a further 0.25%. Now, what was really interesting about this, so of course, yes, interest rates going up is not very nice. Obviously, we know the knock-on impact this is having to pricing in the market. And for those people who are on tracker rate mortgages, you know, even a 25 basis point increase can make a huge difference in terms of their monthly costs. But actually, I was just reflecting on this. I was listening to Radio 4 and some people talking about this, and it's a really interesting point. So yes, of course, you know, base rate is now the highest it's been in the last 10 years. However, it's also still historically low. So base rate has been around for over 300 years, and the last 10 years represent the lowest, including where we are today, the base rate has ever been. So essentially, what we have been seeing is artificially low interest rates, and what we are actually experiencing now is really a return to normal. So I think, you know, it's just probably worth keeping some kind of perspective on this when we're talking about interest rates. People are saying, gosh, you know, they're going up, they're really expensive. Actually, you know, yes, they will feel expensive compared to what you may have been paying, what you might have been able to access. But actually, in terms of the broader context of where interest rates normally sit, actually, they're not particularly high at the moment at all. In terms of what people are expecting going forwards based on the news yesterday and what's going on in the wider market, people are now expecting rates to maybe cap out at around 2% this year. So at the start of this year, they're expecting 1.5%. They're now saying it could go as far as 2%. Now, this week's been no exception in terms of lenders putting their rates up, and I'm going to go through those in a second with you, but just to kind of give you some context first of all in terms of where pricing now sits. So 2-year fixed rates for people borrowing in their own names now start from 1.94. 5-year fixed rates are now starting from 2.25%. Limited company rates, so 2-year fixed from 2.44 and 5-year from 2.79. Now, what's really interesting in that is you would have noticed there's circa 0.5% difference between personal rates and limited company rates. Traditionally, there's been between 1 and 1.5%. So actually the margin at the moment has come right down in terms of the price differential for borrowing through a limited company. I don't think there's anything too drastic to read into that. I think it's just a case of timings essentially. So people who would lend sort of these very low rates to individuals tend to be clearing banks who have to react much more quickly to changes in swap rates. The lenders who are lending in the more specialist end of the market don't tend to work from that model. They tend to work from the money markets, and therefore they can be a bit slower to react. So at the moment, the price difference between a limited company and personal is just 0.5%. I think we would expect that to grow again in the coming weeks. So what's been happening with the lenders specifically? So first of all, we've seen Clydesdale increase their rates by up to 0.16%. So their pricing now starts from 2.4. We've seen Bank of Ireland increase all of their buy-to-let rates by 25 basis points. Their rates are now from 2.72. Landbay have made increases of between 0.05 and 0.15%. They've also withdrawn all of their limited edition cashback products and have not yet replaced them. Their pricing now starts from 2.99. Barclays have made increases between 0.1 and 0.3%. Their pricing now starts from 2.15. TMW have made increases of between 0.1 and 0.75%. Their pricing now from 1.74. We've seen BM Solutions increase product transfer and further advance rates. We've seen TML make increases of up to 15 basis points. We've seen the Coventry withdraw all of their 5-year fixed rate products, which have £2,000 or 1,999 arrangement fees. And also their portfolio buy-to-let range as well, which has been withdrawn today. They haven't yet bought out replacements for those. We've seen Aldermore withdraw around 12 of their products. So what they've said is they're not actually looking to increase pricing at the moment. What they've just done is reduce significantly the number of products they have available. So a cull on the number of products available from those guys this week. And we've seen Kensington withdraw their special edition products. So just to remind you guys, special edition products is when a lender comes to market with a rate which is essentially cheaper than their standard product range, which is available on a limited edition basis, which means it's only around for a certain period of time or to a certain tune, an amount of lending. So, we're going to do a 5-year fixed rate at 2.5%, and we can do £50 million worth of applications. Once that money's all gone, then they pull the product. So limited edition products from Kensington have been withdrawn for the time being. Now, in terms of criteria, a lender has made a change this week, which I thought it was worth mentioning, just because it doesn't tend to come up too often in the buy-to-let space. So the Buckingham Building Society has launched a new buy-to-let mortgage product, which is aimed at those with non-standard credit, credit-impaired, adverse credit would be another term that you guys may be familiar with. Now, what they're saying is this launch follows an increase in applications from borrowers who've had a life event that has impacted their credit profile in the past. So what they're saying here is essentially that they have seen a bunch of applications coming in from people who've had a kind of one-off event in their lives. So, for example, they've had a bereavement, a period of ill health, unemployment, they've lost their jobs, which obviously, particularly during the pandemic, would have been something that become kind of more rife. And what they're saying is that, look, if someone is generally, on the whole, a really good payer, they tend to pay things on time, but for a very specific period, in time on their credit report, you can see that there are missed payments, and they are able to consider these guys, because these people are not habitual non-payers. They're people who have actually just been down on their luck and has something bad happen to them. So I was looking into their criteria in terms of actually what do they class as credit impaired or non-standard credit. So what they're saying is that you can have a maximum of 2 missed payments on unsecured and secured loans in the last 3 years, but none in the last actual year. Missed payments on all mail orders, utilities and secured loans are accepted. Defaults up to £1,000, outstanding in the last 3 years, but none in the last year must be satisfied. CCJs up to £250, outstanding in total in the last 3 years, none in the last year must be satisfied. Mortgage arrears, they can accept a maximum of 1 in the last 3 years, none in the last year. And payday loans, a maximum of 1 in the last 3 years, nothing in the last. Okay, so look, where does this sit in terms of the market? So there are quite a few lenders where if you have the odd missed payment on an unsecured credit line, mobile phone, that kind of thing, they can largely just ignore them. Missed mortgage payments in the last 12 months really are a very, very big no-no. But actually, beyond that, there are lenders who can be quite flexible in these things, particularly if you can demonstrate, I think, that you had the money in a bank account, but you needed to transfer it to the account that pays the mortgage, and you simply didn't do it. So it's an administrative error. So you weren't in financial difficulty, you simply had messed up on your administration. So there's lenders who can take a view on that kind of thing as well. So yes, that's really, really good. Now, in terms of payday loans, this is a really important one. Lenders really, really dislike payday loans, really dislike them. You will find that if you have taken a payday loan in the last couple of years, you're going to really struggle to find a lender to lend to you. And this is because payday loans are so incredibly expensive. They really should be regarded as the kind of last chance saloon. So you would only take one of these if you really, really were very, very stuck. So lenders tend to be very concerned that people who are using payday loans are not managing their finances very well. They're under financial duress. And these are people that lenders are going to kind of want to step away from lending to, because the last thing you want to do for someone who's in financial difficulty is indebt them further. So great to see that Buckingham really trying to take a pragmatic view, consider what's been happening the last 3 years, and try and figure out a way they can really kind of support borrowers going forwards. Is their criteria particularly wonderful? I think it's generous. I don't think they're the only lender who can do these kinds of cases. We have people with credit blips, and we're able to generally find homes for them. But actually, the pricing's not bad. It starts from 3.39%. So definitely an option, which is great to see come to market. Okay, so news has come out in terms of licensing. So Oxford City Council's selective licensing scheme has been given the green light, meaning that all private rented homes in the city will need a licence from September. So just under half, so 49.3% of all Oxford homes are privately rented. An independent review in 2020 found that a fifth, so 6,200 of the 30,500 homes in Oxford's private rented sector could have a serious housing hazard. So approval of the selective licensing scheme means Oxford will be the only council outside of London to require licensing for all houses in multiple occupation and other private rented homes. So a 5-year licence is going to cost £480, but there will be an early bird discounted rate of £400 for landlords who apply for the licence within the first 3 months. There's also going to be a discounted fee of £280 for accredited landlords. Why is this important if you don't have a buy-to-let in Oxford? Well, I think really this is just kind of setting potentially a path for the future. Licensing of all landlords on all private rental properties has been talked about for some time. Seeing a council like Oxford go into this, obviously joining London, really could just give us a very strong indicator about how things could be looking for landlords going forwards. Okay, now this bit of news is a good one for landlords because it tells you a bit about how long you can expect your tenants to stay on, and also really give you an indication about the robustness of the rental market just now. So renters are remaining in properties for nearly 2 years on average, this is according to an industry body, Property Mark. So what they're saying is that renters are staying put for an average of 23 months. And they said this is a lack of available properties, which is contributing to renters remaining in homes for longer periods, with just 8 properties available to rent on average per member branch in March. An average of 93 new rental applicants were registered per member branch in March, up from 78 in February. So what this is really telling us is that more and more people are registering to rent properties, but actually the number of properties available to rent on the market is coming down. So this is really kind of underpinning a lack of stock, and therefore people staying on for a longer period of time in their properties. This further is backed up by the comment that rental prices are also on the increase, just over 7 in 10, so 71% member agents reported rents increasing. A slight decrease from 74% in February, but significantly higher than a year earlier when 60% reported rising prices. So essentially here what we're seeing is there's not enough properties available to rent in the market, which is driving up real competition for these properties, which is driving up rents. So again, as always with the housing market, it's that supply and demand tension at play. HomeTrack have released their latest report, and there's some key headlines that I just wanted to share with you, which will give you a really good indicator about what's going on in the property market. So the first thing they say is that the average value of a UK property is now close to £250,000. That's up £29,000 since the start of the pandemic. That's an increase of 8.3%, incidentally. The highest price growth is in Wales, where average values were up 12.1% over the last year, compared to a 3.4% increase in London. The supply of new homes for sale is rising, up a modest 3% on the 5-year average, but some areas are seeing significant increases. But higher buyer demand is driving activity, with sales agreed in the run-up to Easter running circa 27% higher than pre-pandemic levels. Upwards pressure on pricing has pushed 4.3 million homes into the higher stamp duty brackets after the last 2 years. So once again, supply and demand, house prices still going up for now at least. Now, one of the really key indicators in terms of what is going on in the buy-to-let sector, how many landlords are investing or divesting, is where you can look at the actual level of buy-to-let lending that's taking place in the mortgage market, and that will give you a really good kind of steer as to what's actually going on. So I was really interested to read a report this week which gives us some really good data. So the value of residential loans to individuals within the buy-to-let sector totaled £36.9 billion last year. This is an 8% drop on the £40.1 billion lent in 2016. Now, the people that were commenting on this, and this is a chap called Jonathan Samuels, who's chief executive at Octane Capital, has really put this drop down to the fact that he thinks that a lot of landlords are essentially divesting because landlords are really, really tired of the what he classes the war waged on landlords. I think maybe that's probably slightly over zealous, but anyway, these are his comments. So he's putting things down to the notable legislative changes, or including the restriction of tax relief, the abolition of wear and tear allowance, 3% increase on stamp duty, payable on buy-to-let homes, and accelerated payment schedule with regards to capital gains tax. So what they believe is going on here is that the reason that the value of the buy-to-let mortgage market has decreased is because people are divesting. So last year, the 36.9 billion loaned via the buy-to-let sector accounted for just 11.7% of total lending. So we look at all the mortgages that were lent in the UK last year, buy-to-let was accounted to 11.7%. Now this marks a 4.4% drop on 2016, when buy-to-let loans accounted for 16.1% of the total sum lent that year. So essentially, as a market share, buy-to-let lending has come down from 6 years ago. Now, despite all of this, the analysis by Octane has also showed that these sector is standing tall still, both in the current market and when compared to historic market performance. So the amount lent to buy-to-let investors in 2021 is one of the highest totals, surpassed by only first-time buyers, which was 74.3 billion incidentally. Those remortgaging from other lenders, 64.5 billion, and those loans listed as with regards to house purchases, so 118.7 billion. So this annual total also remains 170% higher than the 13.7 billion lent to buy-to-let investors in 2011. So with buy-to-let lending still accounting for 11.7% of total lending in 2021, this market share also remains 2.8% above 2011, when buy-to-let loans accounted for 8.9% of total lending. So what they're essentially saying here is that actually, yes, it depends, I suppose, when you're measuring from. If we go back to 2016, market share of buy-to-let in terms of overall lending has come down, but when you compare it to 2011, actually it has increased. And actually, in summary, despite the comments that was made previously in the report, Jonathan Samuels has said that the sector is still standing really, really strong. And actually, the reduction in the total value of buy-to-let loans issued in the last 5 years has been marginal compared to when we stand today versus a decade ago. So actually, in the round, despite the numbers actually on face value maybe looking slightly concerning, he sees the news story has been very, very positive. Is this reflective of what we're seeing in the market? So yeah, I think it is fair to say that some landlords are choosing to divest their portfolio at the moment. Some are stepping away from the market. But what's really, really interesting is, despite everything that's going on in the world right now, so all the economic uncertainty, cost of living, interest rates going up, we are still seeing a large number of new-to-market investors considering whether they want to go into buy-to-let and actively purchasing at the moment. Indeed, the thing that they say is holding them back is not any of the kind of economic backdrop that sits behind us right now. Actually, it's just the inability to find something to buy. So very, very interesting different views on the market. If you wanted to share your thoughts on where you see being a landlord at the moment in the comments, we'd absolutely love to hear from you. And that is everything from us this week. Sorry, slightly longer one this week, but I felt that all the articles that we shared today were actually really relevant, and I didn't want to hold one over to next week because it runs out of date, doesn't it? So then it's no good to anybody. So, as always, thank you for joining us. If you do have any questions, please do give us a call, 0345 345 6788. As always, our website stands there with a huge amount of information, mortgagesforbusiness.co.uk. So it's just left for me to wish you a wonderful weekend, and I will see you again next week. Take care until then.